Bank regulators have seized Silicon Valley Bank in the largest bank failure since the Great Recession.
Get the money out.
Customers were rushing to take their money out.
There are recent developments that concern a few banks.
SVB is now the biggest American bank to fail since the 2008 financial crisis.
What caused the collapse of Silicon Valley Bank? From being the 16th largest investment firm in the US and holding $210 billion in assets till 10th of March to nearly being bankrupt as of now, where did it go wrong for the Silicon Valley Bank? In this video, I am going to tell you all the reasons for that failure of a US bank. Let's take it from the start. So, SVB, Silicon Valley Bank, is a commercial US bank headquartered in Santa Clara, California. It was founded on October 17, 1983 by Bill Biggerstaff and Robert Medearis. The bank is making headlines for all the bad reasons. It's on the brink of bankruptcy and ringing an alarm bell for other commercial banks as well due to the economic disaster globally. The major reason for its failure is the bank rush and the inability of the bank to raise enough capital for its clients. Experts and corporate commentators are terming it the biggest failure of the bank after the 2008 global financial crisis, so it became the biggest U.S. bank collapse after the Washington Mutual collapse happened in 2008. The problem started when the bank sold the bonds of $21.8 billion at a loss of $1.8 billion to enhance its revenues. It came up with yet another announcement that the bank was going to sell 2.25 billion new shares to raise the capital even after suffering a loss of $1.8 billion earlier. This sent a wave of shock among the investors and all the capitalist venture firms. They started withdrawing the money from the bank, which caused a bank rush and it almost went bankrupt. It is noteworthy to mention that Silicon Bank was holding 85% assets of uninsured depositors and merely 15% was of insured clients who will be paid as early as Monday, according to a statement issued by the Federal Deposit Insurance Company. The stocks of the bank crashed on Thursday and it halted its withdrawals. Other banks including First Republic, PacWest Bancorp, and Signature Bank also followed the suit and closed down the withdrawals. Another reason for the decline of Silicon Valley Bank is the higher interest rates by the Federal Reserves. To control the skyrocketing inflation in the US, interest rates were made higher last year and it caused many losses to the Treasury bonds, and assets lost their value overnight. When the interest rates were near zero, banks increased their assets, but once the interest rates went up, the assets lost their value and caused unimaginable suffering to the banks and their clients. So what's next for Silicon Valley Bank, SVB? The bank had been put under the control of the Federal Deposit Insurance Company, FDIC, so the first question that comes to our mind is, what is FDIC and why FDIC? So basically, Federal Deposit Insurance Company is an independent agency which oversees the financial institutions in the US and which liquidates the bank's assets to pay back to its clients and the depositors. In a statement issued right after the takeover, FDIC said that it was waiting for the market to close down and all the insured depositors will have access to their deposits till Monday morning. As far as the uninsured holders are concerned, they will get the deposits until next week along with the profits. Collapse of Silicon Valley Bank will have huge and far-reaching consequences for all the startups and the tech industry, as 50% of the startups in Silicon Valley are the clients of SVB, which will be at the receiving end of this massive financial disaster. Silicon Valley Bank has been an important partner of startups, investors, and founders in the US over the period of the past decade, and its decline will impact other regional financial firms as well.
Silicon Valley Bank collapsed on Friday. It failed to raise enough money to end its capital crisis, and now companies like Etsy are feeling the impact.
As SVB's collapse is mainly due to the bank's investment in the Treasury bonds, which are highly impacted by the changes in the interest rates. It bought the government bonds with low interest rates, and when the interest rates were raised by the federal government, it lost its value. Bank also had $80 billion in Treasury bonds with an average yield of 1.5%, but no one wants to buy the bonds when other companies are offering a yield of 5% due to change in interest rates. This caused a blow to the depositors and the investors who rushed to withdraw their investments en masse. And now we will talk about something which makes this whole situation very messy and horrible. Before the bank collapsed completely, management of the bank sold most of its assets, and the details include: CEO sold 11% of his stocks. CFO sold 32% of his stocks. CMO sold 28% of his stock.
So the CEO, as I alluded to, of SVB Bank, 2 weeks before the collapse, withdrew $3.5 million. If that's not insider trading, tell me what it is.
This gives a deeper insight into this whole situation and gives an impression that management was aware of this disaster and they saved their own investment first. There is also something very important to be kept in mind. Most of the banks operate under the confidence of their clients, and once the trust runs out, then it's a disaster for the banks, such as the case of Silicon Valley Bank. Higher interest rates have lowered the value of treasury bonds and other securities, and the bank was unable to pay back to its clients. That's why the FDIC was forced to take over and oversee its operation.
On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, this is an important point, no losses will be borne by the taxpayers.
The Trump administration passed a bill in 2018 which removed certain checks on the banks in regulating treasury bonds. This gave the banks and investment firms a free hand to manipulate the assets of their clients, and the current disaster of SVB is one such example of poor regulations. Commenting on the current situation, the U.S. Deputy Treasury Secretary said that regulators are closely monitoring the situation at Silicon Valley Bank and the government will provide every assistance to bail out the SVB.
We are concerned about depositors and are focused on trying to meet their needs. We want to make sure that the troubles that exist at one bank don't create contagion to others that are sound.
He was of the opinion that we have tools and methods to handle a situation like this, and we are in touch with the Silicon Valley Bank for more information and deep analysis of the problem. Now let's talk about the companies which have deposits in Silicon Valley Bank and will be most impacted by this disaster. Below is the list. Roku, $487 million. BlockFi, $227 million. Roblox, $150 million. Ginkgo Bio, $74 million. iRhythm, $55 million. Rocket Lab, $38 million. Bank also had operational offices in countries like China, India, UK, Israel, and Japan. Thus, failure will send a wave of shock and uncertainty in these countries alike. Other banks like SVB, which are connected to tech and crypto industries, may have a rough period ahead due to lack of confidence from clients. Still, the question remains to be asked whether this particular situation will impact the rest of the economy in general and tech industry in particular.